Hey guys, this is lesson number 49. We have talked about a lot of different things so far. Previous classes we've covered, recently speaking, we've covered some currency questions, we've covered balance of payments, we've covered exports and imports, trading, comparative advantage, and then a little before that we talked about monetary policy. So what are we going to talk about today before we talk about our homework question? We're going to talk about how appreciation and depreciation occurs in currencies, okay, and how that happens graphically. Why does an exchange rate for any country change? What are the different reasons? How do we connect monetary policy to currencies? Okay, and then if we have time, we'll go over tariffs. So we're at the tail end of our macroeconomic course. One of the most important things to think about before we wrap up our macroeconomic class is currencies, because they are important in international trade, they're important in economics in general. So please make sure you pay attention to this part. The homework question from last time was as follows. Please draw me a graph of the US dollar market. And I wanted you guys to tell me the price of the dollar in terms of euros. Okay. So to my left, we actually built this model from the last class, and we have the price of the dollar in euros, right? So this is the dollar market, right? The US dollar market. And we had the price of dollars in euros in terms of the y-axis. On the x-axis, we have the quantity of dollars, right? So we're good there. We have the x-axis and the y-axis. We have a very, very, very similar demand and supply lines. Demand is downward sloping just as usual, supply upward sloping just as usual, right? And equilibrium always dictates two things, the price and the quantity. What does the quantity tell me in this case? It's telling me the quantity of dollars that are available in the foreign market, okay? What about the price? It tells me the price of the dollar in terms of euros in this case. This could be in terms of anything, right? It could be, literally, it could be the price of dollar in rupees, it could be the price of dollar in GBP, which is pounds, right? So it could be anything. So it just depends on how you want to put it. But typically speaking, people have euros in their mind because the European economy often comes to your mind when you're working on these things. So it's fine. I mean, you can have the price of dollar in terms of euros. And we gave you guys an example. We said this equilibrium creates we made this up. In terms of price of a dollar in terms of euros is 0.5. That means that basically for every $2 you get 1 euro. Okay, just flipping the 1/2 gets you that kind of answer. So this is the answer. This is the simple and straightforward homework question. Today we're going to work on how appreciation and depreciation works. Okay. On this right side, before I start to erase it, we said exchange rates. Again, I just want to go back and rephrase real quick. We said technical definition. We said that the value of one country's currency in terms of another. So it's one value of a country's currency like the dollar in terms of another. We said Europe has euros, right? A lot of Western European countries have euros. So value of one country's currency in terms of other. This would be the exchange rate, right? Exchange rate is often denoted by E, right? E, normally little e or big E, just depends. I've seen both, but that's exchange rate. Practical definition, from a practical standpoint, how can you think about it? We said how much of one currency you must give up to get a unit of another. Okay? Simple, straightforward. All right, so let's talk about appreciation versus depreciation. Okay? So I'm going to go ahead and erase this. And let's talk about appreciation and depreciation. So I'm sure all of you, when you read the papers, you kind of see how currencies appreciate, depreciate, things happen all the time. At one point, euro became so valuable, people invested in the euros, and now European currencies are losing again for a lot of different reasons, the Greek economy being one. Anyways, that is a different topic for a different day. But today we're going to cover appreciation versus depreciation. Appreciation. It's hard to say appreciation. Okay, so why do currencies appreciate? Let's talk about appreciation first. Okay, a couple different reasons. They could be one of the famous examples that people tend to give in classes is that the interest rates tend to dictate that. So if an interest rate, actually we've talked about this before. I don't know when you guys remember this, but we talked about how interest rates actually affect the way you put in money into a country or not. So if interest rates are high, right? If interest rates are high, what tends to happen is it becomes an attractive investment for foreigners, right? So let's say the U.S. Interest rates are high, which they're definitely not right now, but let's say the U.S. interest rates are high. Foreign investors, or if they look at their own economy and they say, well, interest rates are not really that high, but the U.S. is high relative to us, what they'll do is they'll increase the amount of investments, right, within the U.S. market. The way they bring in money into the U.S. market is because they want to invest money, right? Because if it's higher interest rates, they get higher money back. But the trick is they have to put it in U.S. currency. So let's draw a graph. Okay. And we'll say that the Europeans are going to invest in the U.S. So we're going to say that this is the price. This is the dollar market, by the way. Okay. This is the price of the dollar in euro. So this is the exchange rate, right? And then this is the quantity of dollars. Great. Again, pretty simple, straightforward stuff. We have a demand, right? And we have a supply. We said the equilibrium dictates two things. We said the equilibrium dictates the quantity of dollars. Fantastic. In terms of price, it dictates the exchange rate, right? So this E is the exchange rate, and let's say it's at 0.5. Okay. Awesome. That was just the homework question, actually, and that was pretty straightforward. Demand, supply, pretty straightforward. But let's give the scenario. Let's say the interest rates in the U.S. went up. Okay. So the U.S. all of a sudden is attractive for investors because, relatively speaking, they're going to get more money back in the U.S. than their own country. So if you compare interest rates to their own country, let's say Europe, let's say the interest rates in the U.S. are actually higher. Okay, they're higher. So what's going to happen is that the demand for the U.S. dollar is going to increase. Why is that true? Okay, why is that true? Because if I realize I'm in Europe, okay, I'm an investor, and I all of a sudden realize that the interest rates in America are higher than mine, and the interest rates are going up. Okay, and speculators, that's another thing. We'll talk about different reasons why a particular currency is going to increase. But basically, let's for now assume that interest rates will be continuing to rise. Okay, so as a European investor, it's pretty attractive because at home for Europe, for me, the interest rates are not that high. Okay, so I say, great, fantastic, interest rates are going up. I'm going to put in money. The way I do it is if I have 100,000 euros, okay, 100,000 euros. But I need to invest in America. I need to invest it in terms of dollars, okay? So I'll convert the money, and I'll put it in the U.S. in terms of dollars into a bank account, and I can reap the reward with the higher interest rate. Makes sense? The euro goes out of my bank account. I'm European for this example, okay? Goes out of my bank account, and goes to the U.S. into a U.S. bank account, still under my name, okay? There's no difference there, okay? But I get to reap the interest rate of a U.S. bank account because it's in U.S. currency. So imagine it's not just me, it's a whole bunch of people because the interest rates in the U.S. is going up. So all around the world, people are interested because it's a good time to invest in the U.S., right? Interest rates are going up. So what that does is this sudden inflow of money into the U.S. as U.S. currency, because other currencies are getting translated, right, is going to increase the demand for U.S. currency, right? People want the dollar. So this demand is going to rise to D1. Again, parallel shifts just as usual. Two arrows to show that it's moving to the right. Okay. Now all of a sudden look at the new equilibrium. If you go down here, we have a higher quantity of dollar, right? Because obviously people are transferring money from their currencies, right? I've transferred my money from euros to the dollar. Same way, you've got this inflow of a lot of people doing this, so the quantity of dollars in the market is up. But here's the cool part, right? When you see the equilibrium, the price of a dollar in terms of euro, because of this increased demand, it's actually higher, right? It's actually higher. So all of a sudden, instead of being €1 to $2, right, 0.5E, it's now probably at 1, right? So $1 to €1. So all of a sudden, this currency has appreciated, okay? The dollar has appreciated. Okay? Be careful, guys, because I talked about capital account and current account and how you have to be careful about reference points, right? you're thinking about, am I talking from a France perspective? Am I talking from the US perspective, right? So be careful of whose eye you're part of, right? So now imagine you're coming from the US perspective. The US dollar has appreciated in this case, right? Because the demand for the US dollar has increased, and that has caused the increase in the price of a US dollar in terms of euros. But something else has depreciated, right? Something else is depreciated. Should be straightforward, but for those of you who are still thinking about it, the euro has depreciated, right? If you look at this, right, it used to be at 0.5. That means that for every 1 euro, we could get about $2. All of a sudden, if it's at 1 euro to 1, the euro has actually relatively depreciated, right? It's lost its value. So when people ask you, has appreciated, depreciated, always ask yourself which currency and where. Which currency and where. So the US dollar in this case, US market, has appreciated. The hardest part about exchange rates is understanding what's appreciated and what's depreciated. If you are clear in the graph and you understand which market you're in, okay, and you read this about 2 times at least, price of a dollar in euro, you'll understand what's appreciated, what's depreciated, okay? What's appreciated, what's depreciated. Understand that, okay? Understand that. All right, so if on a generic level, so how do we define appreciation? Well, we said that if the price of currency goes up, it's appreciated, okay? It's appreciated. So appreciation takes place when the price of a currency goes up, okay? But always remember the reference points. US or euro, just depends. It could be Algerian money, it could be French money, well, that's the euro. It could be Swiss money. Just make sure that you just understand which reference point you're coming from. In general, if the price of a currency has gone up, it's appreciated, okay? All right, let's talk about depreciation, okay? And after depreciation, we'll talk about why currencies appreciate, depreciate. I'll give you guys an example of each initially. We've given you an example of appreciation. But let's give you guys an example of depreciation, okay? So let's go ahead and erase this part. All right, so we said that appreciation means that the price of currency has gone up. Now, obviously, economics being the science of opposites, we find that the depreciation just means that the price of currency has gone down, right? Price of currency has gone down. This is called a depreciation, right? Depreciation, okay? What is depreciation? It's the price of currency going down, okay? And how do we draw this? Let's draw this graphically, okay? Again, the dollar market, right? We're back in the dollar market. You don't have to be in the dollar market. This is just an example. So, you know, you can have, in the questioning, have euro market, whatever you want. So just be careful to that. This is just an example, okay? So you have a price here of the dollar, right? In terms of euros. In euro. Again, downward sloping demand graph. Okay. Upward sloping supply. Equilibrium. The quantity of dollars, right? So quantity of dollars. And here's the price of dollars in euro, right? So equilibrium states we have a quantity, certain quantity that the dollar's at, amount of money, and then the price. Okay, let's say this was at 0.5. Okay, so this is, you have to have, for every 1 euro, you get $2. Okay, so 0.5 is the exchange rate. Okay, so y-axis is exchange rate, x-axis is the quantity of dollars in the market. Let's give you guys an example. Let's say that all of a sudden, we realize that the European economy, which right now is not doing so great, right? Realize that the European economy does not have a good future. Okay, I'm an American investor, Right? Imagine I'm an American, right? I'm investing in different economies. And I actually thought for a long time, like everyone did, and it happened, right, that euro was a great investment. The exchange rate was falling, right? If you think about it, the euro was worth more for a long time, okay? But now all of a sudden, with Ireland not doing so great, with Portugal, Greece being Greek economy being a problem for euro in general, the euro is becoming weaker, okay? And the European economy is not doing so great, right? So me being an investor, from my standpoint, I think it's not a great time to invest in euro anymore. I want to pull out my money, okay? I want to pull out my money. And what I do is I sell all my euro and I transfer back to dollars. What that's going to do is it's actually going to shift the amount of supply of euros. But in this example, we're in a dollar market. Let me give you the exact opposite example, right? Let's say that I'm a European investor. I said in the previous example that US interest rates were going up, okay? At that time, I thought it was a great investment, but now I don't think so. I think the US economy is not doing so great. I think the metrics show that things are going south. So from my standpoint, from a European investor standpoint, I think that it's time to pull out of US, okay? So I'm going to sell all my US dollars and move it back into euro. So what that does is actually it shifts the supply of US dollar, right? Because how does that happen? Because I'm taking my money, which was in a bank account somewhere in the US, because I was earning high interest rates and I wanted to keep it there. But I decided that it's time to get back into the euro. So I pull my money out, but someone has to take that dollars out of my bank account. They have to take it, and they have to give me euros, right? And it's going to cost money, okay? So that flow of dollars has gone back into the US economy. It was sitting in my bank account, right? But now it's back. And that way, what it does in the market is it shifts the supply to the right. When investors get out of a currency, it shifts out to the right, okay? Now, obviously, there's adverse effects. First of all, there's more of that money, right? We see this increase. But here's the problem, right? The dollar depreciates. Again, understand that the US perspective is depreciated. If you look at this, right, we're now let's say 0.3, okay, 0.3. So for every, if this is 3 over 10, well, 10 over 3, well, 3.333, 3.3 repeating, dollars gives me 1 euro. So the US dollar is actually depreciated. It's depreciated. What about the what about the euro, right? We're talking about price of dollars in euro. So euro has appreciated. Okay, euro is appreciated. So basically, if the price of a currency goes down, it's depreciated. Price of currency goes up, it's appreciated. Understand, understand, understand. I'm going to say this one more time. What reference point you're coming from. Very, very, very important. Okay? So now the big question. What changes exchange rates? Okay? So we'll go over this. And this is probably very important for you guys, so make sure you write it down. Okay? So let's go ahead and erase this board. And we'll talk about exchange rates. So we already talked about two things, right? We said, in our example, we said we appreciated the dollar. How did we do that? We said the interest rates in the US economy, in our example, has gone up. Okay? So they've gone up. What about depreciation? We said, well, the US economy doesn't look so great. There's speculation that the US economy is not going to do great in the future. So me being the European investor, I come out of it. Okay? I come out of it. And that has depreciated the US dollar. So I gave you guys two examples already, but let's talk about everything. Let's talk about what are the big reasons, okay? So what changes exchange rate? Huh? So here's the big question. What changes exchange rate? And we'll go over everything. This is not in terms of significance, guys, so don't bother yourselves over, is this an order of significance? But I will tell you this, interest rates are a huge example, okay? And why are they a huge example? Because we'll talk about it, but let's talk about interest rates. So I gave you guys an example. We said in the US, we said if there's increasing interest rates go up. We said that the amount of investment actually goes up. The amount of investment goes up, the demand for the dollar actually went up. Okay, D dollar stands for demand for dollar. Why is that true? Well, and again, this could apply for any economy. We're giving a dollar perspective because some AP tests have a dollar, but sometimes they give you euro, sometimes they can give you Indian rupee. It just depends. So from our perspective, we're looking at it from US interest rates. We're saying that in our example, the US interest rates have gone up. What does that mean? It means that for me as an investor worldwide, again, relative, because let's say in my country, interest rates are already really high. I probably don't care if US is going up because relatively speaking, I don't need to invest. But let's say interest rates are going up and relative to my country, it's actually pretty attractive to invest. Interest rates going up means that if I put money in the US economy, in the US bank account, I'm going to get higher interest rates. And if there are higher interest rates than my country, I'm willing to bet I want to put my money in the dollar, okay? Because I get more money back, right? So if the interest rates go up, right, the demand for that currency goes up. If the interest rates go down, the demand for that currency goes down, right? Again, dollar being just an example, okay? So let's talk about the second possibility. So we talk about interest rates, huge factor in changing and affecting currencies and exchange rates. Let's talk about more pertinent to third world countries is political stability. Political stability. Okay. Political stability is huge because if you do not trust a government, right? So let's say a government is not so stable, you're not going to invest your money in there because what if the bank system just collapses overnight, right? What if the president of that country just takes over the bank system, right? You're not going to trust them. So you will not trust economies that are not stable. If they're politically stable, right? I mean, the US does have a lot of political instability, but relatively speaking, it's not going to affect the government and affect the financial system, right? For the most part. That's why the US Treasury bond is the safest investment in the world. Okay? Safest investment in the world because of this political stability factor. And that's why people invest in Western countries. But I mean, obviously when you invest in third world countries, you might get higher growth rates back, whatnot. But in terms of stability, we just feel that it's more politically stable. So political stability has to do with interest rates, okay? How strong the currency is. The more stable, the stronger the currency, generally speaking. Let's talk about the relative level of income, okay? Relative level of income. Why is that important? Well, generally speaking, the higher the level of income, okay? The higher the level of income in a country, okay? Let's say that all of a sudden, the US's income goes up, okay? Things are doing great, economy bounces right back, things are looking good. If I'm making more money, okay, and I'm coming back, that's the word we always say, it's called purchasing power, okay? So relatively speaking, my purchasing power as an American, because my economy has gone up and income has gone up, has increased. So I can buy other goods, relatively speaking, I can buy more of other goods, right? So if my income goes up, generally speaking, my imports go up. Okay, so how does this affect currency and exchange rates? Well, if you imagine, let's say I can buy more imports, right, and my demand for European goods go up, okay? They go up. And if that's true, well, relatively speaking, European goods are going to have more demand, and I'm willing to bet there's more demand for European currency. So actually, it might actually devalue my currency. It might actually decrease my currency power, okay? But again, relative level of income, important, okay, important. Let's talk about relative inflation. Relative inflation. All right, relative inflation. So if inflation goes up, okay, so let's say you're in some country A, and inflation is out of control. Things have become really more expensive. Relatively speaking, okay, the same good in the other country, in another country, is going to be cheaper. So what that's going to do is it's going to increase my imports. Okay, and again, my currency is going to decrease in value. Okay, and I will confirm this again in the next class for you guys, just to make sure we're all on the same page. Okay. The last one we're going to talk about is speculation. Okay. Last one is speculation. Speculation. And we talked a little bit more about speculation in our depreciation example. Speculation. Why is speculation important? Well, let's speculate that the European economy is not going to do that great based on a lot of different variables, right? The Irish economy, Portugal economy, Greek economy, right? Spanish economy. So me as an investor, I'm speculating the fact that the European economy is not going to do great in the future. So what I'm going to do is and first of all, that information is widespread. So all the investors are going to pull their money out of the euro because they believe that it's not going to be as valued. So speculation can increase or decrease currencies, exchange rates, excuse me. Okay. So exchange rates are heavily based on speculation. So speculation is definitely important. Okay. So another part of speculation actually is about speculating about interest rates. If you speculate that the interest rates in the US are going to increase, let's say, for example, people are going to invest more money in the US dollar, right? Because they believe that in the future interest rates are going to go up and they're going to make more money off of that. Okay. In the next class, we'll cover how we can connect monetary policy to the value of the dollar and how that affects everything. All right. That being said, let's talk a little bit more about let's just do a quick recap. Interest rates, how they affect them. Well, interest rates, if they go up, that currency is more in demand. Simple as that. Because what that's going to do is if there's higher interest rates, it's more interesting for an investor. Okay, it's more attractive. You get more money out of it. Okay, so the demand for the dollar is going to go up, or whatever the currency is, where the interest rates are going up, and so the currency is going to appreciate. There's also political stability. It looks like my shirt got political stability. More stable an economy. Okay, more investments in that economy, so the higher the demand, okay, of that currency. So currency will appreciate, higher the political stability. Relative level of income. Let's say you make more money in that country. Okay, relatively speaking, goods are more cheaper in other countries, so imports are going to increase. Okay, so demand for foreign currency is going to increase. So that means it's going to depreciate your currency. So currency will actually get depreciated if your income goes up. Vice versa is, of course, holds true. So if your income goes down, your currency actually appreciates. Relative inflation. If your inflation goes up, that means that relatively speaking, again, the same concept we talked about before, goods are cheaper in other countries. So your imports are going to increase. If your imports increase, actually that's going to devalue your currency. Okay? So your currency actually goes down. Vice versa, again, true, inflation down, price levels are tanking down. That's going to do is your exports are going to increase and the currency is going to become stronger. Last thing to talk about is speculation. Speculation, basically, you can speculate about different things. The economies, interest rates, all of those dictate how currencies work and exchange rates. Okay. Price of currency, if it goes up, it's appreciation. Price of currency goes down, depreciation. All right. And with that, I think I just want to give you guys your homework question. Homework question is basically the last part of the lesson, which is what changes exchange rates. All right. So what changes exchange rates? Give me we talked about 1, 2, 3, 4, 5 reasons why it can change. So give me the 5 reasons for changes in the exchange rate. With that, I'll see you guys in the next class. Thank you so much for joining in. See you guys in the next class.